Hello there, Salim Omar here from CPA Marketing Genius, bringing you another guest. I've got somebody very special with us today. His name is Jody Grunden. Jody, welcome.
Yeah, thanks, Salim, for having me on.
Really, really excited. I've known you for a couple of years
Mhm.
and been very impressed with your journey. And so I'm so glad you accepted my invitation
Oh, for sure, for sure.
to be on this episode. Very quickly, Jody, I'm going to share a little bit about your background, and then we're going to dive right in because I feel like you're going to just bring so much to us through your well, what you're going to share.
Mhm.
So, folks, Jody, he's an accounting visionary with over 20 years of experience. He has helped pioneer innovative changes within the accounting and tax industry, including the introduction of the first subscription based billing method employed by an accounting firm. He's the author of two books, Digital Dollars and Cents and Building the Virtual CFO Firm in the Cloud. Jody built a very successful CPA firm with his partner, Adam Hill. And the name of the firm was Summit CPA Group. And then in last year, I believe, Jody merged his firm with another firm. So there's a lot to unpack here. Jody, you started your firm as a traditional CPA firm, like so many others, and you challenged the status quo. You challenged the way the business was operating. Talk
Mhm.
to us about what led you. Why did you challenge it? Why were you not happy with the traditional model? And then what did you do in that process?
Yeah, I'd be happy to. I started my career out in public accounting, working for two large regional accounting firms, probably top 10, top 15 firms right now. And with that, realized pretty quickly that I like the idea of working on many different clients. That was a lot of fun, going from one client to the next, learning what they did. But the hours were just unbearable. Couldn't handle the hours, especially during tax season where the expectation was working a ton of hours. I super important with my family, coach my kids in hockey. My kids are growing up, and it was one of those things that, hey, this just wasn't working out for me. And so I went to the corporate world, and with the corporate world, it solved a lot of issues there. I actually had time now. I was working
Mm,
45 hours a week. All that kind of stuff was great, but the challenge just really wasn't there. It was like Groundhog Day for me. It was the same thing over and over and over again. And as I continued to work in that position, I made my job. I guess I took a 40-hour or 50-hour work week and brought it down to a 30 down to like a 25 because I fine-tuned everything. I made everything streamlined, and it made it so that it was pretty much on a pretty much a regular flow. And with that, it became super boring. And so I was kind of an orphan between jobs. It was like, hey, I got this accounting degree. I love what I'm doing, but bored at the corporate level. Didn't want to really go the public accounting level. So I got an opportunity to leave the corporate world and run a small office. And I thought, you know what, maybe a small firm is what I'm looking for. Maybe that's the golden ticket. And I was working for a very small regional firm, and I say small, it was under a couple $100,000, so super small. And with that, realized pretty quickly that I just don't, I can't have a boss. I've got to be the entrepreneur in me. Kind of kicked in, and so I thought,
mm,
hey, let's start a new practice and let's do it a little differently. But so I jumped out of that, bootstrapped completely. I had no money at all. I borrowed money from my 401k. I had credit cards, and that's kind of how I started it. And I would never tell anybody to ever start a company like that ever because it's super challenging. And
mm,
I got a young family. I've been married for at that point 3 or 4 years, and with that, it was like, hey, I've got to make this successful. And so, what did I do? I went back into the traditional model. I jumped in, charged by the hour,
mm,
did tax returns, did really what only thing I knew how to do. And within I'd say about 2 years, I realized pretty quickly that I was creating the exact same monster that I was trying to get out of or trying to evade. And at the same time, I was running out of cash. And so I had to figure out how could I do things differently that maybe it's outside of the box that no one's ever done to be able to solve my issue. And I wish I could say I created all this, but it just happened because I was forced into it. I couldn't be the bank anymore, so I created the subscription-based billing model. And so I thought, well, how am I going to get clients to pay me on a regular basis without me invoicing a client? That was the big thing.
Mm.
And so with
Mm.
that, I thought, well, hey, if I meet with the clients, all these tax return clients I'm charging, let's say back then it was probably 10 grand or 8 grand or whatever it was. What if I worked with them on a regular monthly basis, fix all their issues, and then at the end of the year, I just simply put the tax return together? And that would be pretty quick. We'd have really a big tax season. I thought, well, this is a great idea. And so I started doing that. And so then it's like, well, what do I talk about with these people when I'm meeting with them on a regular basis? And,
Mm-hmm.
and, and at the time, I was just talking about historical stuff. It was more the financials. Here's how you did. Here's based on how you did. So I think you'll probably do going forward, or here's what your tax situation might look like based on it. But it wasn't really concrete, and it wasn't until I started introducing just a simple 13-week cash flow forecast. And it sounds kind of simple now because a lot of people provide that already in their service, but back then we didn't. And that was
Mm.
something I took from the corporate world. I did that on the corporate side. For a $250 million company, I created a 13-week cash flow every single day for this giant corporation. So I thought, well, heck,
Mm.
if that corporation benefited from it, I'll bet these little guys would too. And in little guys, I mean, smaller companies. And so I provided that forecast, that outlook, and it was like all of a sudden lights were coming on in these business owners' eyes. Like, wow, it seems pretty simple for us as accountants, but it wasn't for them, and it just kind of
Mm.
opened their eyes up. Wow, this is kind of cool. And then it was like, well, can you guys provide more? Can you provide it longer out? A longer forecast, let's say a year. And so we thought, yeah, we could definitely do that. And back then it was with Excel, and you're crunching numbers and everything, and we we're providing a year forecast for the client so that they could see a better perspective on what they were going to, what their business was going to look like. But then I realized pretty quickly that it couldn't just be based on percentages and stuff like that. You couldn't say, oh, yeah, we're going to increase your sales by 5% each month. I had to really dig in and figure out what were the non-financial drivers for clients to be able to
Mm.
provide that forecast, right? Something that they actually could control. And,
Mm.
and it became like for a trucking company, it was like, how many trucks are going to come through? What's the repair model on the trucking company? Like maybe it's a repair shop. When do the trucks typically come through? Is it in the winter because of the snow? And I could start really predicting and really kind of helping the client where they can actually control those outcomes. And so it was kind of neat because each month we'd meet with the client and we'd talk about, hey, it looks like you missed your mark. How many trucks did you have come through? And they're like, oh, we only had 5. Well, you had 10 on the forecast. Do you think that's going to be 10 for this next month? What do you have in inventory right
Mm.
now? Or how many are you going to
Mm.
sell? Or and then it became a conversation. It was a strategic
Mm.
conversation. It was like we were actually creating and modeling it for them. And then we could flip it over and show them, hey, based on this, here's what your cash position is going to look like. November is
Mm.
not going to look bad anymore because you had such a great March or April.
Mm.
And here's what your tax situation is going to look like, which was great because then they
Mm.
could plan on it. And so then there was really no surprises. So they're actually managing their company, and it was really a great thing. And we continued to do that to the point where they're like, hey, can you do other things for us? And we're like, well, sure. And so, like then we started providing the service on a weekly basis versus monthly, and it quickly became to a weekly pay cycle where instead of, so because we actually productized our service now, we could provide that ongoing thing, got rid of the billable hour, we're able to flat fee it. And with that became, basically a value-based subscription-based model where we were able to charge a weekly fee and clients loved it. No pushback at all. First thing I thought of is
Mm.
clients are going to hate this. We're going to send them an invoice every week, but we don't send them invoices. We just simply zap their bank account. We put the agreement
Mm.
together. Here's what the weekly fee is, and zap their account. They loved it, and the reason they loved it because it never came up anymore in the conversations. Before it was like, hey, I know you're kind of tight on cash, but you're 2 weeks behind on our fee. Can you get that conversation never happened. It was more like
Mm.
it is automatic, like an ACH, like a rent payment coming out automatically.
Mm.
And,
Mm.
and clients, they just loved it. And from there, we developed the subscription-based billing model where we could, can basically take that client and collect that fee automatically until the subscription changed, until there was a scope change. And
Mm.
it was nice. It was a great way of doing it. And like I said, I wish I said it, wish we came in the idea, hey, I got this great idea and invented it, but it was more of a necessity that, hey, I've got to
Mm.
fix this one issue, which was cash for Jody, who didn't have cash
Mm.
and couldn't afford to be the bank and didn't really want to follow or chase the billable hour when it came to hey, when the client, you got four people in the meeting, the client's like, hey, why are you charging four people? All that kind of stuff.
Mm,
That all that went away. We actually started being able to focus on what was most important to the client, and that was their business and helping their business grow. And so it led to the subscription based billing model in that way, but it also created other issues because now we're stuck in this model, right? We're stuck in this dollar amount because I just
mm,
promised the client, hey, here's what it's going to be. And so what it forces us to do is it forces us to innovate. Innovation's thrown out there as a buzzword, but it truly forced us to innovate. It's either
mhm,
that or go broke, because you're kind
mm,
of stuck, right? You're stuck into a
mhm,
profit model that could be super profitable or might not be profitable.
mhm,
And with that, the goal was for every client that we had to have a 75% contribution margin to it, meaning direct costs had to be 75%. When we brought clients on, that's just not how it worked out. The model sometimes gave us 90%, sometimes 80%, sometimes 50%, but the average had to be that 75%. And if I was okay with that, then that was cool. But if I'm not okay with that, then I need to
mhm,
figure out how to change it. And the problem is I can't go
mhm,
back to the client and say, hey, here's the agreement you signed. I got to increase it. That just doesn't work.
mhm,
So I had to figure out ways to bring it down through
mhm,
technology, through better processes, through
mm,
having the right people doing it. And so it
mm,
really changed the way that we ran the company, because a lot
mm.
of times you can hide a lot of accounting firms can hide mistakes or process issues through the billable hour. They just bill more, and
Correct.
the client ends up paying more.
Right.
And then you have that agreement. But with us, it forced us. Hey, here's the dollar amount we promised the client. And here's how we. In order for us to get that, we've got to figure out ways to do it. And so
Mm,
it made it fun. It made it fun to
mm,
figure things out, figure processes out, and I wish
mm,
I could say it figured it out from day one, and then it was perfect for that next 20 years. No, it just created more things that we had to figure out as we hired more people, bigger
mm,
clients, and so forth. How do you charge a flat fee to a client that's $1 million client versus a $20 million client? Completely
mm,
different. So we had to figure out how to
mm,
scale that. We scaled it based on revenue. Worked out really well. Client that's a
mhm,
bigger client's going to be paying more for the same service because we're providing more. we're doing
mm.
more things. We're providing profit sharing plans and all that kind of stuff for a bigger client. Whereas $1 million client, that they're not thinking of that. They're thinking of how do we get to the next month without having cash issues. So it's different. It's different for different size of the companies without scaling it for different things. So again, you kind of a long answer to a quick question, but it was just more that we were forced into it, and we had to figure out ways to figure it out. And the nice thing about it was I didn't have 20 years of accounting behind me, so I didn't have 20 years that was beat into me that here's how you do
Mm,
it. I had the world's my oyster, right? I could do really whatever I wanted to do. It was my company,
mm,
and
mm,
it didn't have to be a traditional accounting firm. It could be we could create to really whatever made the most
mm.
sense, and that's what we did.
Yeah. One of the things that gets in the way for a CPA firm that's looking to adopt this is I don't have thinking that they don't have the expertise to bring that type of value to a client where they can have these conversations with clients and they can help them figure out that, hey, because of this, this can happen, and because of this can happen. What advice would you give someone who is kind of in that, in that spot?
Yeah, it's a great question because a lot of people they like when we thought that the cash flow that hey that was something that we knew obviously and everybody knows how to run a 13 everybody runs a 13-week cash flow. Any business owner would be silly if they didn't have that. When we dug into it, nobody had it. We were the
Mm,
ones that had it. And that's the thing, we discount ourselves so much as accountants. We have so much information out there. We've dealt, especially if you've been doing it for a while. You've dealt with several different industries, you've heard a lot of different things. You may be tax only, but man, when you're meeting with those clients, you're talking about that. You've got a vast knowledge. And so what we had to do is we had to figure out how do we productize that so that we can talk about specific things during meetings. Because when you think about it, the big issue is what am I going to tell a client every week? Talk to them every week. Seriously, what am I going to talk about? Well, it was for me, it was fairly simple. My personality type, it was like, well, I can go in and ask questions, probe for questions, I could figure it out. And we could have a very productive meeting every single week. And I wouldn't really need to come prepared for it necessarily, because just by probing questions, right? But for the new CFO that I hired, He didn't have that personality type. And so it was a different experience for that person. And so
Mm-hmm.
that created, hey, how do we solve it so we can scale it? Because unfortunately, it can't be me. And I'm not going to go hire
Right.
anybody in my personality type. That's not going to work. And so I had to come up with names of meetings, purposes of meetings. And so we did.
Mm.
We had a revenue rec meeting in which we met with the owners of service-based companies for that 1 hour, for that week. We met with them. We went through, hey, here are all the different invoices that we had. Basically, it was revenue rec, going through the invoices, making sure it all tied out, making sure that we understood how the revenue is created. The next meeting, we thought, well, hey, that's going to be the financial statement meeting. So we bumped right into the financial statements. We closed the meeting. Now we're talking about historical financial statements during that meeting. The very next
Mm.
one might have been the forecasting meeting. So now we have the financials down. Here's what the forecast is going to look like. And then maybe those meetings, we're in that order. Maybe they're in a little different order. We might have had another meeting. Maybe we're talking about job costing, depending upon what it is. So we name the meetings, and which was important. Pipeline meeting was another one. Meeting with them regarding their pipeline if they're a service-based company. So we're tying in revenue, tying in revenue expectations to what we actually created. And so the nice thing about naming the meetings for us, our team knew exactly what we're going to talk about during that meeting, which was important. And the client knew. So the client knew to bring whomever they had on their team to that meeting. So if it was a pipeline meeting, well, they're going to bring their salesperson in, or they're going to bring their project manager in, or whatever. If it was a forecasting meeting, maybe only the people that are pertinent to salaries are going to be in that meeting because we're going to talk about
Mm.
salaries. And so the client knows that and understands,
Mm.
and they can bring the right people so that we're not wasting a bunch of their time or our time in doing so. And what it did is it really created that repetitive process. Hey, every
Mm.
third, every first week of the month, we're talking about this. Every second week, we're talking about this. And if the client needed to talk about something that that was more of an emergency, well, we just changed the meeting, and the meet now we're talking
Mm.
about whatever the client wanted to talk about in that meeting. And so the
Mm.
fluidity there, but I think the key was naming the meetings and knowing that hey, we bring a lot to the table. And strategy really deals with the forecast. The forecast to me is the strategy part of the meeting. And if you
Mm.
understand how to deliver a forecast to a client, not a budget where you just set it aside and you talk about it once a year, you compare to it, every month. Hey, here's what
Mm.
we predicted back in November. That means nothing. It's the forecast. It's how life changes and how that impacts going forward, both the balance sheet and income statement. 90% of the folks on this call understand that pretty clearly, and 90% of
Mm.
folks on this call could explain that to a client, and really use that as the model in which they do it. Now we meet with clients weekly, but not everybody has to meet with clients weekly. We have clients, half our clients we meet with monthly. So we meet
Mm.
with them 1 to maybe 2 times a year, or in a month, not a year, but 1 to 2 times a
Mm.
month going through things. So 50% of our clients we meet with weekly, 50% monthly. We try to split it up 50-50 for the CFO, so they're not bombarded with 20 weekly phone call or 20 weekly meetings, with different clients, that sort of thing. So it's one of those things that I think that for most people on here, they can handle it without even thinking about it. They just need to actually go out and do it.
Mm. Did you evolve from doing the subscription model, Jody, with many different industries, and then you started niching in one
Yeah.
or two?
Yeah, because when we started back in '07, putting the subscription base, we had all kinds of industries from trucking to baseball, baseball to nonprofits to you name it. We had everything. And we still do have about 40% of what we do is everything. So it's so when we say niching, doesn't mean that that's the only thing we do. It just means that's what we focus on. And so it wasn't for about 10 years after that that we started focusing on what we call creative agencies, which would be like web design companies, web development companies, SEO, SEM, pay-per-click marketing agencies. That was kind of the niche that we thought, hey, let's really see if we can really focus our marketing towards and go after that client. And it ended up being about 60% of our client base over time going through that niche. And so it was kind of nice that we could actually provide that, which made it even better because now our team understood the vernacular of the client. They had other clients in
Mm.
that same space that they could bring knowledge to the table, not specific knowledge about that client, but knowledge overall. And when we sit and say, hey, we're seeing that most clients are about 20% over last year in revenue and profits down. We could talk about that, with confidence because we've got other clients in that industry. So that
Right.
that made the conversation a lot easier once we did niche it. But we still do it for the other 40% of our client base. we'll use other things like Profit Sense or something like that to grab industry data that we might not have at our fingertips. Or we're big enough now where our CFOs meet every Friday and they're talking about all that kind of stuff. Hey, here's what we're seeing. Hey, did you see, how are you guys doing a profit sharing plan now based on the economic conditions? All that kind of stuff is coming up so that we can work as a team. But initially, it was with really with every industry. And then it made it easier for us once we actually niched.
Yeah, yeah, that's awesome. Yeah. Wow, this is so good. I'm enjoying this. And you've pioneered the subscription model. The other thing that you've really pioneered, and you've given confidence to firms that were considering going virtual. I happen to be one of them,
Mm-hmm.
Jody. I
Yep.
took my firm virtual this past May,
Oh,
and
awesome.
you played an important role there, besides the weekly stuff and just like our conversations over the years,
Yep.
over the months and so forth. But we went virtual, and you kind of, you took a traditional firm and you went
Mm-hmm.
distributed. You took the distributed model route. Um, what were some pieces of advice? Why did you do it? And
Mm-hmm.
is it a good idea?
Yeah, great question. Why'd we do it? The funny part was I wish I could have said I invented it again. I did not. We had a client that was fully remote, so fully distributed. They had about 60 folks all across the United States and Canada and Europe and all over the place. And I thought, wow, this is a really cool model. It allowed them to grow, their culture was awesome. There's a lot of great things. I thought, wow, this would be kind of neat to have it as in accounting. And there wasn't any accounting firms doing it at the time. There wasn't actually any financial firms doing it at the time. And so we thought, hey, why don't we take that risk? Plus, we're growing pretty fast right now. So we're growing at a pretty good clip. It's really hard for us to hire people in Fort Wayne, Indiana, a population of $300,000, with the idea that, hey, we want to really grow and be big. We'd have to be poaching for another firm. It would be a disaster. And so we thought, hey, how can we do this? And we thought, well, let's do it virtual. And so I approached the team and I had this great idea. Hey, we're already working virtual with our clients anyways. Why don't we just simply get rid of the office? And man, it was like it didn't go well for the team. they, they
Really?
they did not think it was a good idea. They gave me all the reasons why, and we heard them. The internet, we couldn't. The culture would go away. How do you know people are working? All that kind of stuff is thrown right at.
Right.
It's
And
like,
this is what, 15 years back, where,
yeah,
or
this is
what
a
was
long
it?
time ago.
Right?
Yeah,
I mean, it's back when, or now it's, this is more accepted, but,
yeah, exactly. And
post
so,
COVID. But before
so we
that,
had
it was like a very foreign concept. It like
Oh,
cannot be done.
big time foreign
Yeah.
concept. Yeah, and it was like a lead brick. That's how it landed. And I thought, you know what, I can't lose my team. And so I thought, well, what I'm going to do is I'm going to remodel my office, which I own the building. That was a great idea back then, own buildings. And I own my own building. I thought I'm going to remodel it, kicked everybody out for about 6 weeks, tore all of the walls out. We made it really look cool. And made it so cool, and it took so long for them to actually do the remodeling that the team figured out how to work remote. And it was like, we kind of like this. And one by one, it was kind of funny because we had 18 folks at the time. So it wasn't a huge firm, but you had 18 team members. And one by one, all but four came to me and said, you know what? I like this remote thing. You mind if we give it a try? And I was like, oh my gosh. So I spent $100,000 remodeling an office that I wish I could have taken everybody to Hawaii with or something. Because
Right.
nobody moved into it. So
Yeah.
the funny part about that is that I ended up leasing it out. It was about a year later, and they had to remodel the entire office again because it didn't. So I had
Oh
office
my
never got
goodness.
used, which was
Right.
which was kind of funny, but it was kind of neat because once we figured that out, and
Hmm.
people really started picking up, and we figured out how to actually be successful, modeling ourselves off of a firm that was already successful, already doing it right, and it was nice. So we did the retreats. It was every 6 months we met the team, brought the team together for a retreat. And we had a lot of extra costs to do that. But the funny thing is, we lost the cost, and that was about 4.5% of our revenue that we spent on
Hmm.
the facility. So we didn't have the
Hmm.
facility anymore, but we reallocated that cost to that. And so there was extra costs. And so people say, hey, if we go remote, we're going to save all this money. It's, well, not really. If you save the money, you're going to have turnover because people need that fun
Yeah.
at some point, and they need that friend
Hmm.
at the office. And it's hard to
Hmm.
develop the friend over video conferencing. You can do it, but it's super hard to
Hmm.
do. But when we have retreats, when they can hang out with each other and grab coffee or grab a beer or whatever that might be, they start talking about things outside of work, and they really start doing that bonding. And it's kind of unique because when we have the retreats, the people just love the retreats and they love coming to them. And they love we get 90 some percent, 90, probably 95% people show up for them, and they stay the whole time, and they stay out late with each other, and they just hang out with each other,
Wow.
all ages. It doesn't make any
And
difference.
they're bringing their spouses as well, or
They bring the
their
spouses only on the last day. So we don't bring the spouses because we want the team to not feel
got it.
obligated to go back to their spouse. We want them to be able to hang out with each other.
Right,
So we
right.
we have that. Then we allow the spouses to come on the very last day, and if they want to
Yeah,
extend it, they can extend it. But that's kind of
yeah.
cool because then they're showing their spouses off to the team.
Right, right.
It's a really a
Yeah.
neat experience overall, and like I said, retention is really low because of that. When we had
Mm,
COVID hit, you'd think, well, we wouldn't miss a beat at all. Well, we did because we didn't have the retreats. And as soon as
mm,
COVID started winding down, we
yeah.
saw people leaving that we would normally not have leave. They were leaving quickly. And it's
Mm,
because they didn't have the people that we hired probably about 6 months before the retreat and during the COVID, or not the retreat, but COVID, never really had the experience of meeting people one on one. Never was able to hang out with,
mm,
and they didn't have
mm.
that stickiness. And so once
Right.
it came back to having the retreats, our retention's been way high, churn's been really low, which obviously happy people, happy clients, profitability all kind of goes there. And so yeah, we learned a lot from that. We learned about how to do stipends, and instead of having with computers and all that kind of stuff, giving people
Mm,
stipends, cards that they can buy their own stuff
mm,
with. There's a lot of things
mm,
we learn in that process that we were able to really take advantage of, 8 years before COVID hit, which
mm,
was nice. And now that the folks are doing it now, it's nice because you can kind of see the ones that are being successful, what they're doing. Are they still being, are they doing retreats? Are they doing things? If they're not
mm.
successful, it's not because it doesn't work, because we've proven it does work. It's just a matter of, are they doing the right steps to making sure that it does work?
Yeah, yeah, that's great. So I'm looking at the clock, and we are coming close to the time we need to finish, and we didn't even talk about merger, and I think that's going to be part two. And
Mm-hmm.
Jody, really, you took a firm, and I believe you grew it to 10 million in
Yep.
revenues,
Mm-hmm.
right? And then maybe you wake up one day, or you have a discussion with Adam, your
Yep.
partner, your business partner, and you say, you know what, we want to merge. And I want to dig more there, but I feel we should keep that as a part two of this
Yep.
series.
Nope.
Would
Sounds
that be
great.
okay?
Yeah, that'd be great. Love to talk about that for sure.
Super great. This was so good. I really enjoyed it. You talked about the virtual subscription model, your innovation there. Talked about the distributed model. Um, with folks want to reach out to you, a resource, one of your books, like what's the best way for them to continue this conversation till they hear part two of this series?
Yeah, I would say that we're all over the internet. So if you just Googled me, you'd see tons of stuff out there. We're super transparent. We like to educate. A lot of generosity is my personal core value, and so it's one of those things I just love giving back and helping out. So Googling, or feel free to reach out through an email if you'd like. I'd be happy to send any of that stuff to you. And then my email is Jody, Jody at summitcpa.net. Again, it's .net, not .com, because I couldn't afford the .com, so we went .net. And so feel free to reach out there. I'd be happy to hop on a call, even if you want to spend about an hour. I'd be happy to do that as well.
Yeah, Jody, that's very kind. And I'm going to plug your book, man, because I read that book page to page, word to word, and it
Mm-hmm.
was fantastic.
Oh,
It's
thank you.
got like so much knowledge, content there. It's building the virtual CFO firm in the cloud. I think that's the one I read a couple
Mm-hmm.
of years back, and I loved it. Took lots of ideas from it. It was really very practical. So I'm going to plug your book. How can folks
Appreciate that.
get a copy of your book?
Yeah, feel free. Yeah, if you'd like to, it's on CPA Trendlines. You can look at that, or I reach out to me. I'd be happy to send you a copy.
Okay, that's generous.
Mhm.
Super great, Jody. Thank you so much, man. Enjoyed it. You take
Thank you,
care.
Salim. It's been great.